Imagine a company that is just bleeding over $100 million a year. Their legacy revenue is cut in half, and, insiders are persistently dumping shares.
Right. Yeah. It's a brutal picture.
But then imagine that exact same stock is up over 600% this year, and they're sitting on $250 million in pure cash.
It's just wild.
So looking at the latest news, you really have to ask yourself, is this stock in a falling trend flashing sell signals, or is it a strong buy? And, why are some people still calling it undervalued after a massive run?
Well, it's the ultimate paradox in today's market, honestly. When you look at the underlying data versus the actual price action, the whole institutional narrative just completely fractures.
Welcome to the deep dive. Today, our mission is to cut through the absolute chaos surrounding one specific ticker. That's Navitas Semiconductor, ticker symbol NVTS.
Yep, NVTS.
And our sources today are like a dense stack of raw financial statements, real-time technical charts, some institutional flow data, and the latest market news. Our goal here is to dissect the mechanics behind the ticker and figure out what is actually driving this anomaly.
Because the divergence between the financial reality and the market enthusiasm here is, well, it's one of the most severe we've tracked all year.
It really is a fascinating split screen. But before we jump into the data, you know the drill. Please like this video, subscribe to our YouTube channel, and leave your feedback in the comments.
Yes, please do.
Honestly, it's absolutely compulsory for the algorithm at this point. Do it for the algorithm or it just buries us in the search result.
What's fascinating here is just the sheer unadulterated scale of this stock's recent performance. If you look at the quote today, Navitas is trading at $12.37.
Right.
That is up an aggressive 20.57% today alone. But the volume is what actually tells the story of the underlying mechanics.
Oh, the volume is insane.
Right. We're looking at a staggering 50.6 million shares traded today. For context, their average daily volume is just over 16 million. So you have this overwhelming influx of capital actively forcing this price upward in real time.
Okay, let's unpack this because the timeline is just staggering. We are talking about a stock that was, scraping a 52-week low of $1.67.
Wow.
$1.67. And it ran all the way to a high of $17.79. Year to date, it is up 73.25%.
Yeah.
And if you zoom out over the past year, it's up 615%. But to understand how a stock obliterates the broader market returns like that, we have to pivot from the flashy chart and look under the hood at the underlying financials.
Definitely.
Because looking at the income statement, the picture gets remarkably grim.
Yeah, the trailing 12-month figures are incredibly difficult to reconcile with a multi-billion-dollar valuation.
Let's run the numbers. Total revenue for the trailing 12 months is $45.92 million.
Okay.
Gross profit is $14.25 million.
Right. Not terrible so far.
But net income is a painful negative $116.95 million.
Ouch.
Which leaves them with an earnings per share of negative 57 cents. Like, how do you generate $46 million in top-line revenue and manage to burn almost $117 million on the bottom line?
It comes down to the structural decay in their legacy business models, basically. If we compare the quarterly data to the annual context, you can pinpoint exactly where the income statement is bleeding out.
Go on.
So in Q4 of 2025, their revenue plummeted to just $7.3 million.
Wait, down to 7.3?
Yeah. That is a brutal drop from the $18 million they pulled in during Q4 of 2024.
Hold on, I want to dig into that. Because a drop from $18 million to $7.3 million, that isn't just a bad quarter. That's a fundamental collapse in demand. What exactly is failing here?
The primary culprit is severe weakness in the mobile and consumer electronics sectors. For years, Navitas relied on providing power chips for smartphone chargers and consumer laptops.
Right.
But the consumer electronics upgrade cycle has lengthened dramatically. People are holding on to their phones for 4 years instead of 2.
Oh, totally. I haven't upgraded mine in 3 years.
Exactly. And that creates a massive supply chain glut. Smartphone manufacturers just stopped ordering new components because they were sitting on warehouses full of unsold inventory.
Makes sense.
Consequently, legacy chip makers like Navitas saw their order books just evaporate almost overnight.
So let me get this straight. They are losing over $100 million a year. Their core legacy revenue just got cut in half year over year, and they're caught in a broader macroeconomic hardware slump.
Yep.
Logically, that sounds like a company spiraling toward bankruptcy.
Well, that is the assumption almost any fundamental value investor would make if they were looking purely at the P&L.
Hmm.
But here is the plot twist that is completely throwing off the short sellers. Okay, I'm ready.
Their balance sheet is a fortress.
Wait, a fortress? With a 9-figure net loss? How does that even work?
This is where you have to separate operational cash burn from capitalized reserves. As of December 31st, 2025, Navitas has $236.9 million in pure cash and cash equivalents just sitting in the bank.
That is a massive cash cushion.
It really is. They have total assets of $500.47 million against only $56.8 million in total liabilities. So their total equity is an incredibly robust $443.6 million.
And what about their debt profile? Because, I mean, in a high interest rate environment, a company burning cash usually has to take on toxic, high-yield debt just to keep the lights on.
That is the kicker right there. Their debt-to-equity ratio is a microscopic 1.46%.
So virtually zero debt.
Practically none. Furthermore, despite the deep GAAP net income loss, their levered free cash flow over the trailing 12 months is actually sitting at a positive $40.34 million. I see the angle, but that feels so contradictory.
It does, yeah.
How does a company dealing with a collapsing legacy business and posting a $116 million accounting loss somehow pull positive levered free cash flow and maintain $250 million in cash? Like, where is that capital coming from if they aren't selling smartphone chips?
The capital injection actually came from a highly strategic institutional pivot.
Oh.
Yeah, in November 2025, Navitas raised $95.6 million through a private placement. They went directly to major institutional players and secured funding for a totally new operational direction. They're calling it Navitas 2.0.
So they basically convinced Wall Street to fund a complete corporate reboot. What is the actual technological shift in Navitas 2.0?
They are abandoning the low-margin consumer electronics space and transitioning entirely into power semiconductors for AI data centers.
Ah, AI, of course.
Always AI, right. But the timing here is critical. AI GPUs, like the ones NVIDIA produces, they require an astonishing amount of electrical wattage. Traditional silicon power chips simply cannot handle that power density. They lose way too much energy as heat.
Right, because data centers run notoriously hot.
Exactly. Navitas specializes in next-generation materials, specifically gallium nitride and silicon carbide. These materials can process dramatically higher voltages with far less heat loss.
Okay.
So Navitas essentially pitched institutions on the idea that they hold the key to solving the power bottleneck in AI data centers. To cement this pivot, they just appointed a new AI director, a prominent veteran in the chip space, to their board.
Oh, wow.
And that specific appointment is what triggered the aggressive institutional accumulation we were seeing today.
Here's where it gets really interesting, though. You have this positive narrative, the AI data center pivot, the new board director, the cash infusion, but the market mechanics are artificially supercharging the stock price beyond just fundamental optimism. Our sources highlight that the short interest on Navitas is sitting at 43.48 million shares.
Right.
That is 22.9% of the total available float.
Which is an exceptionally elevated level of short exposure, especially for a company with no immediate bankruptcy risk due to that massive $236 million cash pile.
Exactly. I mean, it's like trying to hold a beach ball underwater, right?
That's a great way to put it.
The shorts looked at the 7.3 million Q4 revenue and bet heavily on a collapse. But when the AI director appointment hit the news wires, the stock ticked upward.
Yep.
And with an RSI pinned at 84.26, which wouldn't be alarming if volume was tapering, but we just traded 50 million shares today.
It's explosive.
That kind of unprecedented volume at this level of overextension points directly to forced algorithmic covering, not just organic accumulation. The shorts are trapped, and they're being forced to buy the stock back at market price, which creates this crazy self-feeding frenzy.
That volume profile absolutely confirms a squeeze dynamic.
Yeah.
But, as you dissect the flow data, there's a glaring contradiction between institutional behavior and internal corporate behavior.
Yes. I was digging through the insider transaction filings in our sources, and this is a glaring red flag.
Yes, I caught that.
We know institutions funded that $95.6 million private placement, meaning big money is buying the Navitas 2.0 narrative. But the insiders, the executives actually steering the ship, are consistently selling their shares into this rally.
It's suspicious, isn't it?
If the AI data center pipeline is truly as revolutionary as their press releases claim, why are the executives cashing out right now?
Well, this raises a critical question about internal conviction versus market exuberance. Are insiders just executing pre-planned Rule 10b5-1 sales to diversify their portfolios? Or are they looking at the recent $17 highs and realizing the market has vastly overpriced their near-term execution capabilities?
It's hard to tell.
It is. When institutional hype collides directly with persistent insider distribution, the cleanest way to find the truth is to strip away the narrative and look strictly at the technical charts and Wall Street analyst models.
Let's get into the charts then.
Yeah.
From a pure trend-following perspective, the short-term strength looks phenomenal. The 50-day moving average is at $9.96, and the 200-day moving average is at $9.32. With the current price sitting at $12.37, we are well above both trend lines.
Right.
The MPD is at 0.605, showing a decisive bullish crossover. If a quantitative algorithm is just scanning for momentum and moving average alignment, NVTS triggers a screaming strong buy.
It does, but those lagging indicators are really masking the immediate structural risk here.
How so?
Well, you mentioned the 14-day RSI is currently sitting at 84.26. That is an extreme reading. To visualize what that means, it's like an engine redlining in fifth gear without a functional cooling system.
Oh, man.
Yes, it is moving incredibly fast, but the probability of a mechanical failure just compounds with every passing second.
That is a perfect way to look at it. The momentum is totally unhinged from equilibrium.
And when that engine finally stalls, you have to map out where the liquidity pockets are on the way down. The problem is, there is a lot of empty air beneath the current price.
Let's look at the levels.
Key support levels don't materialize until $9.12, then $8.69, and $8.24. Meanwhile, overhead resistance is sitting right at today's peak of $12.42, with further resistance levels mapped at $13, and that previous 52-week high of $17.10.
Okay, so if the technicals are this overextended and insiders are selling, you'd expect Wall Street analysts to be pounding the table screaming at retail investors to sell.
You would think so.
But when you look at the analyst consensus from our sources, they are bizarrely passive. The consensus across major firms is a tepid hold or neutral, yet their own price targets imply a total collapse.
Yeah, it's weird.
The average target is between $8.15 and $8.64.
The disconnect there is severe, and it really exposes how analyst models struggle with paradigm shifts.
So what does this all mean? If the stock is at $12.37 and the average target is $8.50, that implies an expected 30% downside.
Exactly.
Why is Morgan Stanley, who has a target of $3 to $4.20, afraid to just issue a strong sell rating? On the flip side, you have Needham sitting out there as an outlier with a $13 target. Why is the street so fractured on this?
Analysts generally issue a hold in these scenarios because they refuse to step in front of a freight train of retail and short squeeze momentum.
They don't want to get run over.
Exactly. They know the price action is irrational, but their fundamental valuation models cannot mathematically justify the current market cap. The core metric driving their skepticism is the price-to-sales ratio. Navitas certainly has a TTM price-to-sales ratio of 45.94.
Hold on, a 45 price-to-sales ratio for a hardware company?
Yep.
That is completely divorced from reality. Software companies barely command 20x sales multiples because they enjoy 90% gross margin.
Right, exactly.
Once the software is coded, selling another copy costs nothing. But Navitas is manufacturing physical semiconductors.
Right.
They have high costs of goods sold, supply chain logistics, and material costs.
Very high overhead.
A 45x multiple means the market is pricing them like a monopolistic SaaS platform, not a hardware fabricator. Is Wall Street just completely mispricing their margin profile?
You've hit the exact friction point of the entire debate right there. Wall Street isn't mispricing the current margin profile. The market is pulling forward 5 years of speculative AI growth and pricing it as if it has already happened.
Oh, wow.
The analysts are essentially arguing that perfect execution of the Navitas 2.0 strategy is 100% baked into the stock right now. There is zero margin of safety for supply chain delays, competitive pressure, or macro headwinds.
Which leads us directly into the dominant debate playing out on trading floors right now. Is Navitas an under-the-radar AI powerhouse or a highly volatile retail value trap?
Let's map out the trap first.
Okay, what is the fundamental bear case here?
The bear case relies on the psychology of price anchoring. Retail traders look at that 52-week high of $17.79 and see the current price of $12.37. They think, I'm getting a discount.
Right.
But that is a cognitive trap. You are buying a company trading at over 40 times its sales while it remains deeply, structurally unprofitable. We are talking about a $41 million gap loss in Q4 alone.
Right. That's massive.
And their legacy revenue, the segment that actually used to pay the bills, is in active, unmitigated decline. If the AI data center narrative loses its luster, or if their new gallium nitride chips face yield issues in manufacturing, the downside velocity here will be vicious.
Very vicious.
The fundamentals simply do not support a multi-billion-dollar market cap without flawless future execution.
Okay, I hear the bear argument, and the valuation multiples are honestly terrifying. But I'll take the bull side for a second, because the upside scenario isn't just vaporware, it is rooted in tangible industrial demand.
Fair enough.
They aren't just selling a concept. According to our sources, Navitas has over 1,000 AI data center power designs currently in their pipeline. Data centers are hitting a hard ceiling on electrical grid capacity.
That's true. Power is the main bottleneck.
Right. And if Navitas can provide chips that reduce heat waste by even a fraction of a percent, that saves hyperscalers billions in electricity and cooling costs. Add in the fresh leadership from their new AI director, and most importantly, that $236 million cash pile.
The runway.
Exactly. In an era where borrowing costs are punishingly high, Navitas doesn't need to take on toxic debt to survive. They have the internal war chest to bridge the gap until those 1,000 data center designs start converting into booked revenue.
If we connect this to the bigger picture, both the bulls and the bears are analyzing the exact same data, but prioritizing different timelines.
Yeah.
The synthesis of this debate is that Navitas is a company currently suspended in midair. They're surviving on a potent cocktail of institutional hype, short squeeze mechanics, and a pristine cash runway.
Well, running away from smartphones.
Exactly. They're attempting to build a bridge away from a dying cyclical mobile segment toward the highly lucrative hypergrowth AI data center space.
And the ultimate question is whether they can lay the tracks faster than they burn the cash.
Precisely. The bulls believe the bridge will be finished and functional by the time the legacy business completely zeroes out.
Right.
The bears believe they will run out of materials, or more likely, the market will run out of patience before they reach the other side.
Which perfectly frames the timeline for anyone watching this ticker. In the short term, over the next few days or weeks, that 84.26 RSI is a glaring red light.
Absolutely.
The engine is redlining, and a technical pullback to test those lower support levels around $9.12 is highly probable once the forced short covering dries up.
Definitely something to watch.
The immediate catalyst that will dictate the next major directional move is their upcoming earnings report on May 5th, 2026. That call is going to be make or break for the short-term momentum.
And looking medium to long term, the chart becomes almost irrelevant. It will depend entirely on corporate execution. Can management successfully transition those 1,000 Navitas 2.0 pipeline designs into recognizable, high-margin revenue starting in late 2026?
Exactly. The narrative has to transition into hard numbers. Now, before we wrap up, we need to explicitly state that nothing we have discussed in this deep dive is financial advice.
Oh, absolutely not.
We are purely unpacking the data, dissecting the charts, and analyzing the news from the source material provided. You always have to do your own research, formulate your own thesis, and deeply understand your risk tolerance, especially with a stock exhibiting this level of extreme volatility.
And as you build that thesis, I want to leave you with one final variable to consider.
Let's hear it.
Navitas has successfully secured a pristine financial runway to late 2026 to launch their next-generation AI chips. They have the cash, the team, and the technology. But here is the ultimate uncertainty.
What's that?
What happens if the big tech giants, the hyperscalers, decide to scale back their massive data center capital expenditures right as Navitas finally brings their product to market?
Wow. The macroeconomic rug pull. Building the perfect product for a market that suddenly decides to stop spending. That is a terrifying and entirely plausible risk that, honestly, no technical indicator can predict.
It really is a wild card.
Thank you so much for diving deep with us today. Keep a close eye on the volume flow. Mark that May 5th earnings date on your calendar, and we will see you on the next deep dive.